Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. This is Ryan Nauman, and I'm the market strategist here at Zephyr. M&A activity in the wealth management space has remained hot over the years as financial advisors continue their quest for growth in an ultra-competitive space while determining the best business structure to help them achieve their goals. I have on an industry expert and the perfect guest who is going to share some great insights into the process of merging two investment philosophies during a merger and how to make it all a success. But first, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. All right, enough from me. Let's go ahead and get started and bring on the star of the show. I'd like to give a very warm welcome to Mark McCarron. Mark is a CIO and Managing Partner at Wescott Financial Advisory. Mark, thank you so much for coming on the show. It's an honor to have you on. Can you please tell us a little bit more about yourself and Wescott Financial Advisory?
Sure. Yeah. Thanks, Ryan. Thanks for having me. And a little bit about myself. First, I've been in the industry for over 30 years. I got my start after undergrad at Boston College. I did finance, and coming out of that, I said, what would I like to do with that? And so I got an opportunity to join SEI Investments early in my career, which was a great start for me because my job was basically to go around interviewing fund managers, evaluating their investment philosophies, understanding their research practices, and just getting a better sense of the entire asset management world. So spent a lot of time there, learned a lot, and that brought me not only to the Philadelphia area, but to London, where I spent 10 years of my career in London, doing the same type of things, or building out the investment program for the offshore clients of SEI, and then returned back to the United States in 2009 to sort of refocus myself. And at that point, it was a point in my career where I wanted to figure out what I'm going to do next. I was approached by a couple of private wealth and family offices and felt that would give me a great opportunity to take what I learned at SEI and apply it there. And after 7 or so years working within the family office world, Wescott, I was a board chief investment officer in Wescott. And able to, I think, to bring a lot of the learnings, experience, and capabilities to what Wescott was at the time, from that point on. So that's a brief background sort of on my
That's fantastic, Mark. Thanks for sharing. I love your travels, and I'm sure it gives you a good, unique background and experience for your current role as a chief investment officer in this topic, which is really fascinating to me. We talk on this show, on this podcast, a lot about mergers and acquisition and merging two firms and the process and making sure that transition is successful. Very rarely do we talk about the investment management side, merging two investment philosophies together and the challenges that might be present from that. But again, like in my conversations, very rarely do we talk about the investment philosophies. Why shouldn't it take a back seat? But seems like that process takes a back seat during this process of mergers. But why should it not take a back seat?
Yeah, it's critical. And, Westcott, Westcott's been around for 30 years, has been a very successful organic growth oriented firm for those 30 years, actually 35 years, and found, its way through the industry, like adding more capability and finding markets to sell into and really provide, solutions for our clients, right? So it's a fairly sizable firm today at $4 billion in assets under management. But part of that was an acquisition that Wescott did a couple of years ago, 3 years ago. And you bring up a great point. The critical aspect, every time you think about acquiring another firm, the first thing on the list is the culture fit.
Yeah.
How we get along. And I that's critical. Absolutely.
Yeah.
I think the second thing is what could that other firm bring to your firm to make combined firm even better. And at the same time, you bring up the point of the investment philosophy. And I'd like to go into a little bit of depth there because the investment philosophy at the highest level has to be absolutely in line. For example, long-term focus is really important, strategic rather than tactical, cost conscious, tax aware. All of those things make sense from a philosophical standpoint. But really, when you get down to the details, how you implement that particular portfolio and that philosophy can differ quite a lot. And that's the key point that we focused on.
Yeah, I'm glad you brought up the implementation. My first thought would be, let's say you have one firm and they focusing on portfolio diversification. They look at the 9 style box, equity style box, and diversification that way. One firm focuses more like on a satellite approach, ETFs, maybe passive management versus active management. How do you bring those together? What are some, that seems very, especially if you have two very strong viewpoints on each one.
Yeah, that was the case in our situation, right? Both the firm's leaders, Wescott's founder and the firm we acquired founder, had very strong views, very well respected in the industry. In fact, they both knew each other
Okay.
and respected each other. And part of that respect was how they implemented portfolios, how they do that. So I think at the end of the day, if we were someone who would be inconsistent with that long-term view, or if we found major differences in investment philosophies, I think that would be a non-starter. But to the extent that we both believed in long-term strategic strategies designed to sort of be the engine behind the plans for the financial planners to deliver at the end of the day, that really what drives both. I think though the nuances are like, how do you understand the philosophies and the implementation at the next level down? So active and passive is a big one, and ETS versus funds versus other things. That's all vehicle structure. I think that can be worked out. It's about respecting and understanding the differences between how those portfolios have been implemented. And really, at the end of the day, the client base over those 30 years has been comfortable with the way the portfolio has been implemented. So if there was a sudden overnight change to that portfolio strategy, I think that would disrupt and make it difficult to bring along the advisors and the clients that come.
Yeah. Yeah. Very good point. Aligning these two philosophies, whatever the philosophies are, versus passive is always a big one, but there's a lot of other different investment philosophies. Should the alignment, I'm assuming, should be done before the deal closes, but why?
It should be done before the deal closes, but sometimes it's not, in a sense that the you asked at the beginning, sort of why isn't the investment philosophy sort of put first and foremost? And I think that's a function of other dynamics in the deal, the culture, the people, the growth opportunities, and everything else. But at the end of the day, what we found and what I liked about the challenge was that there are some great aspects of the portfolios that came with the acquisition. And I think there's some great aspects of the portfolios that we manage. And for example, we were looking to try to find a middle ground so that our portfolio strategy and implementation, which is a core and a satellite sort of structure, would align with theirs, which was more core and less satellite, I would say, and more passive and less active. But what we did at the end of the day was built a strategy that aligned with our philosophy, but made sense for their client base. And together going forward, that new investment offering was really open and available to all new clients of the combined firm, which made it another growth engine for us. And I think that was really the key point.
Yeah, Mark, and I'm sure as a chief investment officer and in charge of the investment management portion of practice, you obviously take pride in those investment philosophies. You stand behind it. You're convicted. You have some conviction in those philosophies. So that compromise of merging with someone else probably brings some challenges, and especially to you, who is okay. Maybe I need to change some philosophies that I've been using for years. What are some of those challenges to aligning those two philosophies?
Yeah, I think investment and professionals in general across our industry are quite proud of what they've built, are quite connected to what they have, and more than that, it's there's a lot of their credibility built up in their success and in doing what they've done over their years. So finding a way to not necessarily compromise, but enhance, improve the solution going forward. You have to be open. You have to be thoughtful around, hey, this firm that we've acquired has been very successful in their own right. And part of that has been the way they've implemented portfolios. How can we learn to integrate things that they've done to make our portfolios even better? And it's at the margin, right? We're not giving up our philosophy. We're not changing our process. But at the end of the day, we can make more of enhancement of our current portfolio so that our advisors really who have even more choice today to meet a client need, I think enables them and facilitates growth for the combined firm. But you do have to be willing to say, hey, my way is one way, your way is a different way. Let's talk about how we can make both of us even better.
Yeah, you have to come to the table open-minded, I'm
Absolutely.
sure. And it's I often talk about when I'm talking about Zephyr and searching for an investment strategy, a product, it's about consistency, right? You want to invest in a strategy or investment manager that shows consistent style, whether it's large growth, large value, inconsistency in returns and investment analytics. I'm sure that's a case too, like for the end client, is they want to still see consistency from their investment management. Do you see that? And how does that work when you're merging two to make sure you still have a consistent process, consistent philosophy?
Yes, I think that's critical. So as the acquiring firm, we wanted to make sure that the acquired firm's clients didn't see massive change in their portfolios. So we have to be patient, not only because of that disruption it could cause, but also the tax consequences, of course, for taxable clients that say, I've had this portfolio for over 20 years while the size is changing. And by the way, there's tax costs associated with that. We don't want to introduce that disruption into the relationship. At the same time, our job it really goes back to my days at SEI. I was doing due diligence on the way they manage portfolios, evaluating consistencies. For example, there might be a little bit more passive, in some cases, a little bit less active in others. How do I bring that align and find the best offering, the best fund, the best strategy together so that the acquired firm's clients see an improvement in their portfolio, and our clients who have been used to the way that we've managed money for 30 years see a change, but they see a change in the direction that makes their portfolio even better, either cheaper or tax efficient, or better returning and lower risk, or ultimately all four of those.
I'm assuming too, when you make these changes to a portfolio, whether it's the firm buying the other firm or it's a slow process. Like you said, I'm assuming when you make the change on the investment philosophies, it's not overnight. Maybe like a dollar cost averaging type strategy, something that shows consistency but isn't a huge going cold turkey on it.
Correct. Correct. Yeah, I would say, we're 3 years into the acquisition that we've made and we're still moving toward those targets. So you put the target out there that we all want to follow and get to, but you don't force the issue. Taxes, the markets have been strong, right? The markets have been strong in terms of market values, and gains that have been generated keep getting higher and higher. So the cost of transaction, the cost of change is a bit higher today and has been in the last couple of years. So very thoughtful around that. Of course, if there's anything that the combined firms felt wasn't the right fit, we'd make that change regardless of the tax consequences.
Okay.
Yeah, that's another point too. We're not doing this without the input of the investment team that was at that acquired firm. We've that investment leader has joined our team and today is a key voice in what we do as a combined firm. So integrating not only the portfolios, positions, but the personnel, the people who are there, and making sure that they understand what we're doing and that we get really a consensus and consolidated view as part of our investment community.
That's a very good point. Do you think it's important when you're merging two practices to have an investment committee? Obviously, the two, whether each firm has a CIO, the two CIOs and other parties within the firms to make sure all, you know, all aspects are met and discussed.
Absolutely. I think that investment community structure allows for that conversation, allows for any challenges that might come up. And it also allows for some conversation around what could we live with and what do we need to change overnight and that type of thing. Investment committees were, again, it's cultural. It was a nice cultural fit. They were made up of investment people and advisors and operational leaders and firm leaders. So it wasn't just the investment people in the corner making the decisions. It was a firm wide, belief that this is a better solution going forward, and we're all going to work toward it together.
Fantastic. Yeah, that was my next question is who comes to the table? Who's part of that table? Who has a seat at that table? So very good. That includes advisors, operational leaders, and the folks like you that are actually managing the money.
Yeah,
Do
and I
you
would
have, yeah, go ahead.
no, I was going to say, I would just say that, we talked a lot about how the integration of the acquired firm must be managed well, but I think there's another side of that street where we can bring new ideas to that client base in a way that, shows enhancement and improvement in the portfolio solutions that they can offer their client base. So I think it's a nice two-way street, if you will, of shared ideas.
Fantastic. Do you have any tips on overcoming some of the challenges that we talked about of merging two investment philosophies? That what's most important, though, that can benefit all parties, including the two firms coming together, but arguably the most important part is the clients.
Absolutely. Yeah, I think both firms coming together want to avoid disruption and issues post merger. So communication initially is critical, right? How do you make sure that beyond the top level investment philosophy that looks obviously close and clear and consistent, go to next level down. How do you implement the portfolio? What's your view on active and passive? How open are you as a group, combined group, to making adjustments? Where can we find the best of both worlds and deliver even a better solution going forward? That I think has to be a conversation really early in the conversation. If you're looking to integrate and make effective the combined firm. And I'm coming at this from the idea that the firm combined is a better one than the two separate beforehand. And that's critical. So a lot of communication, a little bit more detailed conversation around portfolio implementation, and an open discussion about willingness to where that compromise might be and how to get there and the time frame associated.
Speaking of time frame, what type of time frame do you think is a realistic time frame for implementing a process?
Yeah, I think, maybe it depends a little bit on the market environment. The market environment has been strong, as we talked about. The stock US market's been strong. That's where the majority of assets are. In the equity market, if it was weaker, or if there was a big opportunity maybe to make an adjustment in a less costly way from a tax perspective, maybe that time frame shrinks. But the more the market continues to rise, the more embedded gains there are. I think the more thoughtful we want to be around forcing anything. So I think, we can also make these adjustments in over a 2 to 3 year time frame, as long as we all agree that nothing in any portfolio is a problem. But if we can get closer to a consistent implementation and do that over 2 or 3 years, sort of dollar cost averaging type exposure, I think that's the right frame of mind.
Yeah. Do you find a lot of financial advisors they might do a rebalancing annually? Do you think that is that a good time to slowly implement some of these changes as they're in their rebalancing phase of their life cycle?
Yeah, I think it's a very natural time to do it. So you're looking at the portfolio, we tend to have an annual official review. So at that point, where is the target we want to go to? Where we look at today? We also have had some significant sell-offs at the beginning of this year with tariff conversations. The markets fell a lot. There was also maybe an opportunity to make a really quick adjustment there and switch out some things into something new. That is also an opportune time. In 2022, we saw the stock market and the bond market sort of suffer a little bit of a decline. And that was an opportunity for us to get a bit closer as well. So I think market environment will generate some of that, but also a standard strategic overview of the portfolio on an annual basis. Yes, here's where we are, here's where we want to go, and let's make more progress toward it.
Fantastic, Mark. You mentioned implementation, the importance of implementing the process. What is the most important part of that implementation process, emerging these investment philosophies? Do you have any tips there?
I think knowing that any portfolio implementation that you're doing in a combined way will drive trades and adjustments in client portfolios. So communication to the end client is critical. Why are we making these changes? Why do we think it's better? And that communication has to come from the investment team initially and almost primarily, and making that case to the advisors and the end clients is pretty critical. Number two, understanding what the costs are. That's just not obviously tax consequences are one thing, but even trading activity in portfolios when it's not necessary could raise questions from the clients to say, why is this turnover happening in the portfolio? I think understanding that too, and just keeping costs down in general. So implementation comes down to the rationale for why this choice versus that, and what can we do to make it more sort of get buy-in across the combined firms, but also make sure that the clients who see that change are bought in as well.
Yeah. Throughout this conversation, I feel as if there's one overlapping theme, and that's communication during this process. But
Yeah.
like you said, you just said it, communication between the two firms, but arguably most important, communication with the client, communicating with that client the importance and the value of these changes and how it can improve their outcomes.
Yeah, and this is on the investment side only. There's a lot of other things changing for that client. Perhaps the name of the firm has changed. Perhaps the team structure serving that client has changed. Perhaps the way they're communicated to has changed, meaning they get emails that look different or whatever it might be. But what's really important is the content and the philosophy around why we're doing what we're doing and communicating that effectively so that the client buys in, but the advisors who are representing the firm to that client are able to answer those questions, fully support those changes. So there's a lot of effort, not just before and during, but ongoing to ensure that the portfolios behave as expected and the advisors continue to have confidence in what we're doing.
Fantastic. What is Wescott's investment in M&A philosophy? You mentioned that you just purchased a firm a few years ago, but historically it's organic growth. But what's your investment philosophy also?
Yeah, I would say that when we look at the industry around us, it's a fast changing one. It's a consolidating one. The large firms are getting larger through acquisition, and in Westcott, remains very competitive and must remain competitive in that world. So as we look around the landscape from that perspective, we're open to sort of finding the right combination of groups of advisors or firms that might be able to come in and join us. What we tried to do at Westcott is build out a platform across the investment offerings. So quickly, that's a core, more of a passive core, ultra high net worth, ETF only, and ESG plus impact. All of those strategies are offered to our client base in aggressive, balanced, and conservative versions of those strategies.
Okay.
So for advisors who might want to come in and benefit from that structure, that's the idea, is to build that platform. We've done the same thing on financial planning. We've done the same thing on the technology side of things. However, we're not out there. We're not out there trying to compete with every acquisition, and we're going to find the right fit the right cultural fit, and maybe ask those same questions that we talked about before. If we're going to bring some group in, we have to make sure that not only is the philosophy in line, but the way they think about implementation, the way they communicate, what the advisors need, all has to line up.
Yeah, fantastic. And at the end of the day, it does all go back to culture in some way or form, right? Whether it's a cultural fit in terms of investment philosophy or just cultural fit in individuals working together.
Absolutely.
So,
Absolutely.
what's the most important lesson during that time that you integrated those investment portfolios a few years ago? What's the important lesson that you learned during that time that you can share with others?
I think we touched on it a little bit, but I think be open, not too selfish out there in terms of, this is mine and what we built is the best. Be open, put your head up a little bit, look for ways of improving it, and then looking for ways of enhancing it. So I think if there's anything, it's just that willingness to consider perhaps another way or another way that you can integrate into something that makes everyone benefit.
Yeah, fantastic. Yeah, just being open minded, I think would be very important based on the your thoughts and the insights you shared, Mark. Mark, thank you so much. It was a great conversation and a piece that, like I said, often might get forgotten about, but it shouldn't be when it comes to merging two practices. Great. Thank you so much for sharing such great insight. Where can our audience get more information about Wescott Financial Advisory Group?
Yeah. Thank you, Ryan. And so Wescott.com is a good
Okay.
spot. We're also on LinkedIn, we're on Instagram, we're through other like YouTube, in fact. So you can find us out there, but please, go out and take a look.
I love it that you mentioned Instagram. I'm still trying to figure that one out if I need to go
We're
on
there.
Instagram.
We're there. Facebook, I guess, too. So Facebook
Okay.
and Instagram both. So we got them all covered.
There you go. Mark, thank you again. Fantastic conversation. Very fun. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and on Spotify. Please be sure to like and subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.